Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Hi, this week we have three very interesting webinars for you. First, on the 31st January at 4:30 pm, we have a webinar about the role of fixed income in asset allocation in 2025. In this webinar, we will discuss about the evolving landscape of fixed income in 2025, exploring key themes such as navigating shifting interest rate environments, optimizing portfolio diversification, and identifying attractive opportunities within various fixed income asset classes. The next webinar, titled Invest Smart in Volatile Times, will be at 5:30 pm. This webinar will cover strategies for managing risk, optimizing returns, and building a resilient portfolio in volatile times. And on 1st February at 1:30 pm, we have a webinar titled Multi-Asset Strategy for a Volatile Year. In this webinar, we will discuss how a multi-asset strategy can help you balance risk and reward, ensure steady growth, and protect your portfolio during volatility. If you would like to join us for any of these webinars, please register in the link given below.
If you've been tracking global markets, then the event to watch out this week has been the Federal Reserve's monetary policy announcement. It's something that the markets have been waiting for quite some time because this is the first policy of 2025 and their tone in 2024 seemed to take somewhat of a U-turn and make investors rethink about their expectations for 2025. So let's dive into the monetary policy announcement from the Fed, and we'll begin with a quote from Jerome Powell. The unemployment rate has stabilized at a low level in recent months and labor market conditions remain solid. Inflation seems somewhat elevated. So if we look at the key message that has come out of the monetary policy announcement, on one hand, the Fed seems to be a little bit concerned about inflation. Their exact wording at a later point in the press conference was along the lines of how you're seeing inflation remain elevated but move closer towards their goal of 2%. The other thing that they seem to be less worried about in 2025 is labor market conditions. So if we combine this with some of the things that we talked about in our last video, where we talked about Trump 2.0, here we discussed that a lot of America's policies now are on Americans first, and the focus is about creating jobs and economic growth for the country right where it is. So when we're in this situation, there is bound to be some level of inflation that's triggered from these policy stances. And at the same time, what you're seeing is that it's going to sort of push your growth and your labor market to a more stable stance. So let's take a quick look at where the numbers actually stand today. So if we're looking at what the Fed did in this particular meeting, they maintained interest rates at where they are, which is at 4.25% to 4.5%. At the same time, you're looking at unemployment numbers at 4.1%. So by the Fed standards, this is a relatively low number compared to the historic levels at which unemployment has been. So it's not really an area of concern. And then you're looking at inflation. So if we look at inflation in December, it was somewhere between 2.6 and 2.8%, depending on whether you include or exclude the volatile items like food and fuel prices. So when we look at the overall picture, you're seeing that inflation is moving closer to the target. You're seeing that unemployment is not really a source of concern because you're continuing to add jobs at a reasonable pace. The other thing that came out from the policy is that, again, the Fed is not too concerned about wage inflation, which is something that we need to keep an eye on and see whether there are cascading effects to wage inflation that are going to play out. This brings us to the key takeaways from the Fed's monetary policy announcement. So I think one thing that stands out is that they're in no hurry to adjust their monetary policy stance. It is going to be a very data-driven approach to policy making. The second thing that we need to look at is that the Fed does not have a preset course, which means that, of course, they came out with a summary of economic projections in December and in September and every alternate month last year. But that doesn't necessarily mean that there's a target Fed funds rate that they're working towards. So there is no preset course that the Fed is following. What they are focused on at the moment is bringing inflation closer to 2%. Now, an interesting thing that may come up later in the year is the Fed's 5-year review, where they kind of review their monetary policy priorities, and this is through inputs and feedback from other governors and other participants. So, one interesting thing to see is how the new framework would pan out. And in the meantime, let's look at how the Fed's policy is actually going to affect Indian markets, and a quick look at what is going to happen here. So number one, because you're looking at no preset course as well as no hurry to change the stance, and you're seeing that labor market conditions are supportive of higher interest rates and inflation is still not in target, I think we could be looking at a situation of higher for longer as far as US Treasury yields as well as Federal funds rates are concerned. Now, if you are in higher for longer, what tends to happen is that the dollar gains better status as a safe haven asset. You could see more money flow into US Treasuries, and with their higher yields at this point, what you're going to actually see is FII money flow out of emerging markets like India into the US. At the same time, one interesting and counterintuitive trend that has been happening is that you've seen other safe havens like gold, etc., gain value even though interest rates are moving up. So there's a demand from, say, central banks as well as other forces in the market that are driving the prices of precious metals up. So these are some interesting things to watch out for. Let us know what you think about the Fed policy in the comments below.